how to use 1031 exchanges to neutralize taxes. Okay, first off, 1031 exchanges is actually a tax deferral. It's not an actual tax savings, but the question is, how long can you defer that for? And that's going to be until you sell that new property. So here's what happens. If you sell a property, especially a rental property, it can leave you with a big tax bill. And here's why. What happens is your basis in the property, which is how much you purchased the property for, plus any renovations or things that you've done to that, then the difference between that and what you sell the property for, you're going to get taxed on. Now, typically you're going to get taxed at a capital gains rate if you've owned the property for more than a year and a day. Most of the time though, if you're doing a fix and flip, you're not going to own it that long and you're going to end up paying ordinary income taxes. Now, if you want to do a 1031 exchange, there are some options that you can actually do to help you defer those taxes. But the other problem you run into when you sell a property, especially a rental property you've had for a while, is what is called depreciation recapture. You see, over time, you've probably depreciated that property. Your accountants helped you do that properly, ethically, morally. You've depreciated that. But then what happens is when you sell that property, they say, wait a minute, you depreciated it. We're going to recapture that amount you depreciated, and you're going to have a tax bill on that. Now, I don't like tax bills. I am not a tax attorney. I am not an attorney. I'm not a CPA. Frankly, I'm not even that smart, okay? So I could do this. You can do this. But let me tell you, basically what happens is when you want to do a 1031 exchange, that's a section in the code, and basically what you're doing is you are selling one property and you are rolling all the proceeds or some of the proceeds over to another property. And it has to be what's called a like kind exchange. Let me jump my whiteboard over here so we can kind of talk about it. So let's say you've got this cute little house right here, and for some reason you're like, I just want to sell this property. Maybe it's because you want to upgrade to a multifamily. Maybe, I don't know. You want to sell this property. Let's say you're going to sell this property for $200,000, okay? Let's say that you bought the property for $100,000. So this is what you're going to sell it for. This was your original purchase, was going to be $100,000. And let's say you currently owe about $75,000 on the property, okay? Now, there is going to be some depreciation recapture. You're going to want to talk to your accountant about that, which will put the basis in there. I want to keep this really simple. So what I want to say is, hey, basically, you're selling the property for $200,000. You owe $75,000. So what we have is $175,000 of equity minus fees and agents and all that stuff, but we're keeping it simple here. And you've got $125,000 worth of equity and $75,000 worth of debt is basically what we're saying. Now, here's what happens. You say, okay, I want to go buy another property. Well, let's say, I'm going to give you a few scenarios here, so I'm going to change colors. Let's say that you want to go buy a property that is less expensive than the one that you just did. Well, you can roll it over. What's going to happen is you've got to roll over all of your debt and you've got to roll over all of your equity. Well, let's say the new property you're going to buy is $150,000, okay? So we're going to roll over our debt of $75,000. We're going to roll over our $75,000 worth of equity, which means we have $50,000, and this is called the boot. And this is what you are going to get taxed on, is what is left over if you go for lesser property. Okay, so that's the difference there, but you've got to roll all the debt over. So this works well if you're going from a smaller property into a bigger property, because you always have to roll all the debt over. The equity, you don't have to roll all that over, but you're taxed on whatever you don't roll over. Now, let's say you're going to go into an apartment complex and you're like, hey, or let's just call it a fourplex, okay? Beautiful little doors here. You know, I'm an artist. Okay, and let's say this is $500,000. Okay, so you're saying, okay, I'm going to roll all my equity in, which is $125,000. So I'm going to be into this $375,000. And then I'm going to roll my $75,000 worth of debt in. Oh, guess what? I need another $300,000 worth of debt. Yes, that works out because you're doing the same or more than. Now, let's also say here, what if you found a couple of smaller properties and said, hey, you know what? I think what I'm going to do is I'm going to roll this over and I'm going to buy two properties. instead of one property. Can you do that? Absolutely. Now, why would you want to do this? Okay. Well, one of the reasons you'd want to do this is the house is appreciated considerably, and you can take that money and invest in 2 new houses that will go up in value over time as well. You've got more increase, more leverage that's going to go up over time. So that may be a reason that you want to do that. The other thing is you might just be wanting to exchange for a different property. Now it's like for like, but that doesn't mean that you can't go from an investment where you're managing it to something that's like somebody else may be managing that property. So there are some intricacies here. Here's what I can tell you. I think when it comes to fix and flip properties, it probably doesn't make sense to do a 1031 exchange. And one of the reasons is you are on the stop clock. You've got a limited amount of time to locate new properties. You can locate, I believe, up to 3 properties, and then you have to close on one of those properties. You have to locate it, then you have to close on it. Now, there is a thing called reverse exchange where you buy it and then you do the 1031 exchange. It's interesting. There's more paperwork. There's another degree of difficulty. You're going to want to make sure you talk to somebody that knows what they're doing in the 1031 exchanges to help walk you through that. That can be something that can be very helpful for you, because the biggest problem with the 1031 exchange is identifying the properties in the time frame that is necessary and getting those properties closed as well. Because what happens if you identify a couple of properties and then you do your inspections on them and they're all garbage, the foundations are falling down? Well, guess what? You can't identify new properties because you had your ones to identify those. So that's some of the things you got to run into. Now, when do you do this and when don't you? Well, I think the best time to do this is if you're changing from a type of investment, maybe from single family to a multifamily, maybe from one single family house to 2 single family houses. So you're doing this to try and get more properties, and you're doing that also so the appreciation, rent increase, and those things can happen, and you're not paying any taxes on the money until you liquidate that asset. So the thing is you can pay some money on taxes, or you pay all the money on taxes and not do the type of 1031 exchange. So lots of people may think, hey, if I do a 1031 exchange, I'm going to put some money in my pocket. You can, but that is going to be taxed. Whatever you put in your pocket is going to be taxed. So the idea with a 1031 exchange is saying, I'm putting nothing in my pocket. I'm exchanging my equity. I'm exchanging my debt for that or greater, and then I'm reinvesting into another property with the hopes that that property will either give me more cash flow, easier to manage, better areas, whatever the case may be. Like you may want to go from a single family to a vacation home. There are some rules around that. You want to make sure that you follow those, but that might be saying, hey, I'm going to get better cash flow if I do a vacation property in this area. I can't do a vacation property. This one I can, and I'm going to increase my cash flow. Great. So I'm going to do an exchange. That's one of the things you can look at. Now, doing 1031s can really help you grow your wealth very fast. You can look at this and say, hey, every couple of years I'm going to exchange when I'm seeing that the market is right for that, or I'm seeing other opportunities that could be better for me for values to go up, rents to go up, pay down quicker, or just simply getting better cash flows. So one of the things that people don't understand is some of the funding necessary. So I'm going to talk a little bit. I've got a video I've put together of why hard money is the backbone of fix and flip funding. You're going to want to check out this video. I cover why hard money comes before finding a property, why every deal should start with finding a hard money lender, and what you should be looking for in a hard money lender. Check out this video and make it a very profitable day.